Before I start this episode of our Grow It campaign, I want to say a quick thank you to the episode sponsors. They are Wealthify, Invest Engine and Fidelity. I'm going to say a quick bit about each proposition, so make sure you listen to them, because later in the series when I talk about the different propositions out there, they'll be useful to refer back to. Do remember that with investing, your capital is at risk, so the value of your investments can go down as well as up, which means you may get back less than you invest. That is relevant to each of the propositions I'm going to talk about. First up, Wealthify is a multi-award winning online and app-based investment service founded in 2016 and backed by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, £50 for pensions. Wealthify has a simple yet competitive annual management fee. Investment costs also apply, and offers a number of investment products, including a stocks and shares ISA, a general investment account, a personal pension, and a junior ISA. Within each of those, you can invest in a range of managed portfolios with varying risk profiles and even ethical portfolios. For more information about Wealthify, including how to take advantage of our £100 cashback offer, please visit wealthify.com/MTTM. New customers only. Offer ends on the 28th of April 2023. T's and C's apply. Now, Wealthify does not offer advice. If you're not sure whether investing is right for you, then please speak to a financial advisor. Wealthify is authorized and regulated by the Financial Conduct Authority. Moving on to our next sponsor, Invest Engine. Invest Engine offers a low-cost approach to investing with no platform fee if you choose your own investments, or if you'd like a little help, they'll build and manage a globally diversified portfolio to suit you for just 0.25% per annum, or just 25p for every £100 you invest. You can get started with £100, and there is a £25 investment bonus available to new customers if you'd like to sign up via the link in our review. For more information about Invest Engine, visit investengine.com. Finally, I'd like to say thank you to our Grow It series sponsor, Fidelity International. Whether you're just starting out or an experienced investor, Fidelity offers a wide range of investment options with plenty of information, tools, and guidance to help you make more of your money and achieve your financial goals. For more information about Fidelity, please visit fidelity.co.uk/money to the masses. So before I start this episode of our Grow It campaign, do make sure that if you've enjoyed it, that you subscribe to the channel so you can get the future episodes, and also make sure you hit that like button as well. Now, by this point of the Grow It series, you will have a greater understanding about investing your money and growing your wealth. Now, the focus of this series has been on investing in a responsible way that aims to grow your wealth over the long term while diversifying investment risks. As such, I focus on the use of funds to invest in a diversified range of assets and companies. If you decide to use an online robo-advice service that recommends a portfolio for you and manages those investments, as I discussed in the last episode, then often they will build a low-cost diversified portfolio using a type of fund called an exchange traded fund, or an ETF for short. I'll be calling them ETFs for the rest of this episode. Now, even though you may not be running your investments yourself, it's still useful to understand how funds work, as most online investment services will invest in a range of ETFs or unit trusts. If you are planning on running your own investments and picking a portfolio of funds, then it's crucial that you understand the difference between the types of fund structures out there. When researching funds on your investment platform, you will come across unit trusts, investment trusts, and ETFs. In this episode, I'm going to briefly outline the difference between each type of fund, as well as their pros and cons. Now, firstly, unit trusts. They are a type of collective investment, which means investors pool their money together to invest in a diversified portfolio of assets. So rather than individual investors buying shares in individual companies, their money is pooled together into a unit trust, benefiting from the economies of scale, meaning that they invest in a wider range of companies at a much lower cost. You will often hear unit trusts referred to as open-ended funds. Now, this means managers create and destroy units as needed to accommodate money flowing into and out of the fund. And that's because investors purchase units in a fund when they invest in it, and the value of their investment will rise and fall in line with the performance of the underlying investments held by the fund, so those assets. Now, while this means that investors will always be buying units at a price approximately equal to the value of the slice of assets the unit trust contains, it also means fund managers can be forced to sell assets at a loss if investors pull their money out of a fund en masse, or have to buy shares at an inflated price if investors start putting money into the unit trust. Now, unit trusts are the common type of fund most investors will come across when investing. There is a wide choice covering all types of asset classes, and it's usually free to buy and sell them on most investment platforms. Although, of course, don't forget that as with all fund types, the manager will charge a fee expressed as an annual charge, normally between 0.5% and about 2%. That's expensive to run the unit trust itself. On top of that, your investment platform that you choose will usually charge a platform fee somewhere in the region of about 0.45% a year, and that is to cover the administration of your investments and to facilitate any transactions. Now, if you use a robo advice proposition, the costs quoted by that service will often include all of the charges bundled up as a single annual fee of around about 1% a year, but it can be less than that. One of the main advantages of unit trusts is that they offer diversification, and they are typically easy to buy and sell. However, unit trusts can have high fees, including management fees and performance fees, which can then eat into your returns over time. Additionally, unit trusts are typically actively managed, which means that a fund manager will make decisions about which assets to buy and sell on your behalf, but it has to be in line with the fund's stated investment mandate. Now, this is called active management or active investing. While this can lead to potentially high returns, the opposite can also be true, as research suggests over the long term, most fund managers underperform the wider market or passive strategies that track key indices. Investment trusts are similar to unit trusts in that they are collective investment schemes, but they are structured differently. When you invest in an investment trust, you are actually buying shares in the trust, which are traded on a stock exchange. Investment trusts are described as closed-ended as a result because there is a fixed number of shares available. However, as with other traded companies, their shares can go up and down in price according to supply and demand. It means that the value of your shares in an investment trust aren't just determined by the value of the assets held by the investment trust. Investment trust shares can be affected by things like investor sentiment, for better or worse. This could mean that you end up paying less than the value of the assets that the shares represent, known as a discount, or you could pay more, which means that you've bought at a premium. Now, whether a company trades at a discount or a premium depends on several factors, and trusts can sometimes aim to maintain a discount, but often the discount or premium is determined by how confident investors feel in the management of the trust. If they have lost confidence in the management, they might sell their shares en masse and thus drive the price of the shares down. The reverse could happen if a manager or trust is particularly in demand. Now, trusts can swing from discount to premium. Of course, if you think about it one way, if you buy shares at a discount in an investment trust, it may feel that you're actually getting the shares that the trust itself hold cheaper than the market rate. So it can look quite appealing. But remember, you also might not get the market rate when it comes to actually selling your shares in the investment trust. So the discount theoretically could widen. It's never a good idea to try and market time the movements of individual share prices, and the same applies with investment trusts. Playing the discount premium game is highly risky, and it's very easy to fall into psychological traps that mean you end up selling low and buying high. Generally, it isn't recommended to buy a trust simply because of its discount or premium. The good thing about the structure of an investment trust is that the managers aren't forced to buy and sell assets just to satisfy investor demand. The decision to buy and sell rests solely with them. This is a huge advantage over unit trusts. So should investors want their money back from a unit trust, then the manager destroys units to enable this to happen. So if there's a large amount of investors wanting their money back at once, the manager will have to sell some of the assets the fund holds. Now, this isn't necessarily a problem, but if the assets that they are having to sell are illiquid assets, so they may be unlisted shares or property, and when I say property, I mean actual buildings, it means that the manager might not be able to meet the withdrawal request, so will have to stop withdrawals from the fund. And that's why it's generally best to avoid investing in illiquid assets such as property or unlisted shares which aren't freely traded on the stock exchange via a unit trust. Investment trusts don't have this problem. So if someone wants to invest in an investment trust or sell out of it, they simply have to trade their shares on the stock exchange via their investment platform, and this has no impact on the assets in the investment trust or the management of them. As investment trusts can be bought and sold on a stock exchange, it means that they are more liquid than unit trusts. So you can decide to sell your holdings and the trade will be placed immediately, assuming there is a buyer at the price stated. However, unit trusts are priced and traded daily. So should you wish to sell out of your unit trust holding, you won't know the final price that you will get when the transaction is settled, which can be very disconcerting in a volatile market, and at worst could actually lose you money if the market moves against you between the time you place the deal and the time the actual deal is enacted, which means that it can even take you days to get your money back. Another advantage of investment trusts is that they can offer income investors a stable and growing income stream. Trusts can distribute profits to shareholders just like any other listed company, but unlike unit trusts, investment trusts can have up to 15% of their annual dividends kept back for another year. So this creates a possibility of a smoothing effect when it comes to income generation. So in theory, an investment trust isn't as vulnerable to fluctuation in dividend payments from one year to the next because they can keep back some of those dividend payments one year and they can use them to pay out to the holders of the investment trust to give them an income stream year after year. Another feature of investment trusts is they can also borrow money, known as gearing, to invest in an attempt to boost returns. And when a trust does this and it actually works out well, they actually make a positive return, then that can boost the return that investors get because of the borrowed money. However, if things go badly, it can magnify the negative returns because, after all, the investment trust still has to repay the loan plus interest, thereby aggravating those losses. So, in other words, gearing magnifies both gains and losses, so it's important to look at how much gearing a trust uses before you invest in it. Given the ability to borrow or gear, the closed-ended structure, and the ability to invest with a longer time frame, then investment trusts can outperform their open-ended fund counterparts over the long term if market conditions are right. However, for the same reason they may outperform, investment trusts also tend to be a little bit more volatile, meaning their value can fluctuate more in a given period than their unit trust counterparts, although it's not a given. Now, this brings me on to the third type of fund, ETFs, the exchange traded funds. And they are similar to investment trusts in that they are traded on a stock exchange, but they are structured differently. ETFs are usually open-ended, but they can be traded throughout the day, much like investment trusts. An ETF will generally replicate indices or specific parts of the market by physically holding the same asset. So if we take an example of the FTSE 100, then the ETF may be aiming to track that particular index. It might hold all 100 companies that make up the index. And it does this by working with an institution like an investment bank, which works on the ETF provider's behalf to buy the underlying assets of the index to match it. This is called replication. Now, this is a physical ETF when they do this. There are other options. You can get synthetic ETFs, which use swaps, which are an instrument that pays the same returns as an underlying investment. So you can get an ETF that tracks, but it does it synthetically. And these types of ETFs are usually associated with commodities or foreign exchanges that don't allow foreign investment. Now, this is because they allow replication in situations where buying the actual physical assets would be difficult or impossible. Then the other type of ETF is known as a sampled ETF, where the ETF won't necessarily hold the assets in an index like the FTSE 100, but might hold a representative selection of them. So the ETF pretty much performs in line with the FTSE 100, but won't necessarily do it exactly. So these styles of investing are known as passive investing, where they track the market or an asset price. And what happens is, instead of having a fund manager, a computer ensures the performance of the ETF mirrors or tracks the price of the index or asset. Now, one of the main advantages of ETFs is that they offer a low cost way to build a diversified portfolio, which is why many of the robo advice services out there will use them to build their portfolios. There are now technically some active ETFs, but we won't worry about them in this series, which are run by managers which choose the assets included in the portfolio and the weightings to the individual holdings. Now, active ETFs are generally higher cost because of that active element to them. But generally speaking, passive ETFs cost around 0.15% a year, up to about 0.25% a year. It can be more, it depends on the manager and the assets that they're investing in. But just like other fund types, you still have to pay platform fees, although there are one or two platforms out there. Invest Engine is one of them that don't charge platform fees when investing in ETFs. But if you consider most other platforms out there, one of the drawbacks, like with investment trusts, is that when you trade ETFs, they will often charge fees as well for actually placing the trade, unlike with unit trusts. So you can see that if you do a lot of ETF trades, the costs of those trades could really quickly ratchet up. So you can see that with each type of fund, there are pros and cons. Most investors will hold unit trusts from a legacy perspective, but more and more are exploring ETFs and investment trusts as they are becoming more readily available on mainstream investment platforms, but also cheaper to trade than they were previously. Income investors will be particularly drawn to investment trusts, and on 80/20 Investor, we produce income heat maps which quickly analyze and highlight those trusts that have a history, or in some cases, a multi-decade history of producing a growing income stream year on year. This is important if you want your investment to produce an income stream that keeps track or potentially beats inflation. Whenever you invest, keeping costs low as possible is important as they eat into your long-term returns, which is why ETFs are gaining popularity. But cost is not the only reason that you will choose to invest in a fund. When investing, it doesn't have to be a choice between investment trusts, unit trusts, or ETFs. There is no reason why you can't invest in all three types if you choose. The key is to build a diversified portfolio that meets your investment goals and suits your attitude to risk, whichever type of fund you use. All three fund types will let you invest in most asset classes. However, you need to ensure that your investment platform offer the options you are interested in and that they are cost effective. Now, in the notes of this episode, we provide a link to a comparison of all the investment platforms out there for stocks and shares, ISAs and pensions, which look at all those charges so you can pick which platform best suits you and what you want to invest in. So if you've enjoyed this episode at all, please make sure you hit that like button and also subscribe to our channel.